Thanks a lot. Thank you to the organizers for both organizing such a wonderful event and including our paper in the program. It's my first time in Montreal, first time at this conference, and I hope I get a chance to come back again. So, wink wink, right? All right, so this paper is co-authored with Benjamin Luce, who's now at UNSW, my colleague Alessandro Previtero at IU, and Andres Hacketal. The paper is about smartphones, as the title suggests, but the big picture question that we are hoping to contribute towards is, what is the effect of new technologies on investor behavior, right? So that's the literature in a big picture sense that we are trying to tie our paper into. And you'll see two more papers on the same or sort of like similar lines in this very session. Right? So there is a decently long list of papers that have looked at different types of technologies. For example, think about like moving from, there's a time where you had to like call in to place your orders, from there to like online trading. So there are papers on that. Then from there to, I guess internet is the same. Then there are like robo-advisors. I think we'll see a paper on robo-advisors. I guess it's the next paper. But what I want to point out here is, if you look at the evidence for all these papers, where does it come from? It looks like it comes from some sort of comparisons of the investor behavior pre and post technology adoption, right? So essentially we are looking at people who start now trading using internet instead of calling their broker. And then we are looking at, okay, let's see before versus after, how do their trading patterns look like? Do they trade more? Do they make different types of trades? There is an exception. For example, Francisco Diacunto and co-authors have this paper where they have a way of potentially randomly assigning technology to overcome this endogeneity of like technology adoption, right? So clearly one big issue in this literature has been selection, right? So who and when they choose to adopt a particular technology. And also, it's both within investor and across investors. So what do I mean by that? So across investor is going to be some particular individuals are choosing to use this technology or adopt this technology at a particular time. Okay? But the within investors is all about, maybe they are only using this technology for a subset of their trades. Right? So maybe there's a subset. Let's say I have my a small portfolio where I have like my playing around money where I want to trade a lot more, and for those trades I use online trading, but for the other ones I do phone calling. Right? So why do I care about this seemingly empirical identification related issue? Because the policy implications may be starkly different here, right? In one case, we are saying if it's just driven by selection, then technology is simply facilitating investor behavior. It's simply helping them do what they would have done otherwise. But if it's changing investor behavior, then it's a different issue altogether, right? So extant literature has not been able to disentangle these alternatives, and our reading of it is it's likely because of the lack of data. So here is where we come in. So in this paper, essentially we use detailed, granular retail investor level data or trade level data, for German investors. To overcome these empirical challenges, and then say something about whether technology is simply facilitating change. Is it actually changing the behavior, or is it simply allowing substitution across different types of technologies within the same investor? Okay. Of course, we need to use a technology to do that. So in our setting, the technology is going to be smartphones, which is very broadly used these days. Just to give you a couple of stats, an average individual in the US, essentially in 2021, spent about 4 hours on their smartphones, right? This is not about trading, just like the amount of time individuals spend on their smartphones. there was another stat that I read recently where essentially which said an average individual looks at their smartphone every 4 minutes in the US, right? So that's the prevalence of the device, and it's crazy, right? Yeah. But so given this prevalence and how widespread it is, of course it is important to understand how it might impact some of the economic decision making, right? And so we'll be focusing on investor behavior. I'm sure many of you have seen headlines like these over the course of the pandemic. We will have something to say about this. Not exactly, because our setting is going to be in Germany, right? So I don't want to claim external validity, but I'll talk about how our results are sort of related to what was going on with Robinhood. All right. Another thing that our data is going to allow us is it's going to allow us to shed light on the mechanisms, right? So what is it about the new technology? What is it about smartphones that makes investor behave differently? Right? So 3 specific outcomes that we'll be looking at. We'll be looking at risk-taking, gambling preferences, and then three biases. All right, so how are we going to get around this issue? So how are we going to get around this issue of selection both across investors and within investor? Okay. So essentially what we are going to do is we are going to compare trades, and when I say trades, our sample is only going to be purchases, so we'll be only looking at buys made by the same investor in the same month but across different devices. So essentially think about what Anna is purchasing using her smartphone in a given month, and then compare those purchases to what she's purchasing on other platforms. So using this within individual month variation, what do we find? Does technology change behavior? Yes, otherwise we would not have a paper. So there is greater risk. So individuals, so the same person.
That sounds like the publication bias being lusted after when you say that. Keep going.
That's fair.
You meant it another way.
That's fair, yes.
You would have a paper.
You would have a paper.
You would have a paper.
Yes, that's fine. Yeah, keep going.
I take it back. We might have it. All right. So, so the same investor in the same month, when they are purchasing something on their smartphones, they are purchasing riskier assets. They are purchasing assets which exhibit more gambling preferences, and they are also exhibiting more biases. Okay? Now, going back to within individual selection, so maybe they are just putting aside some gambling money, right? Maybe they are like, oh, this is fun money. Let me put $10,000 out of my $200,000 portfolio into Robinhood, and let me just play around with it, right? If that were the case, so if I'm essentially simply moving some of my riskier trades, some of my gambling preferences from desktop to smartphones, what am I going to find? I'm going to find that their other trades have become less risky, right? So essentially they are just substituting across devices. But we are not going to find any evidence consistent with this. In fact, there is some weak evidence in the opposite direction. So we're going to find that once individuals start using smartphones, they sort of carry over the same behavior that they learn from trading from smartphones on some of these other platforms, even though the economic magnitudes and the coefficients are going to be much smaller, as you might expect. Okay, so what is driving this, right? So I think, to me, this is as interesting as answering the first part, or the first 2 questions on this slide. So it's not going to be about the features of the app. It's not going to be about notifications. It's not going to be about gamification. It's not going to be about learning from or learning curve for the technology. The results are going to be long lasting. So what is it really about? So we'll find that essentially it's about 2 different mechanisms. One, what to trade and when to trade is going to matter, right? So what are investors trading on their smartphones versus on the other platforms, and when are they making these trades? And when I say when, I just mean in the same day, evening, morning, afternoon. And then it would seem, and then it seems like our results are most consistent with smartphones inducing intuitive, fast, system one type of thinking that is essentially driving the remainder of our results. We don't have a formal decomposition, but if I were to just look at the coefficients and some based on simple back of the envelope calculations, 60% of the results would come from this what and when to trade, and then the remainder 30 to 40% seems to be coming from intuitive thinking. Why do we care? What are the implications? Maybe they are, even if they exhibit biases, is there any cost to them? So we'll find that yes, investors earn lower returns with higher volatility. It's again within the same month, within the same investor, right? So the same investor is just making trades on the smartphones where the Sharpe ratio is going to be lower versus the trades that they are making on the other platforms. Yes, please.
Just to clarify, I sort of missed why do you consider those as two distinct mechanisms? The one on the Y question. You mentioned these are two distinct.
You mean what to trade and when to trade and intuitive thinking?
Yeah, it was like pretty related to me. But
that's fair, yeah. So I don't mean to say that they are mutually exclusive, but the way we try to capture them is going to be, we cannot capture them together. So you'll see when I show the results how we look for one versus the other. Please.
So I can frame this as I'm listening.
Yeah.
So you have an investor who UBS, for an example. So you can trade on your UBS on your computer, or you can use the UBS app on your phone and do it. Are you looking at that as part of this equation, or are you talking about people that have traditional brokerage houses on their computers and then get a fintech, startup that's not part of a big institution and play around with that? What do you look
It's more of the first one, because so essentially we are looking, the data is coming from two retail banks. These banks always allowed like online trading, and then at some point they introduced smartphone trading. So essentially their customers could use either their app or the online platform to do it.
But the app is online. I'm missing something. It's
So
a
you could
small
eat-
screen. It's a small screen. I'm just
Sure, yeah.
No, that's fine. That's fine.
Yes, that is true, yes.
Small screen in your pocket.
Yeah. Absolutely. You can do it while
Like in your pocket, right? Small screen in your pocket.
Yeah.
You can just pull it.
Yeah, it's
Absolutely,
the people,
yes.
it's the people who are on their smartphone at the urinal that bother me.
Exactly. So that is exactly the
Sorry.
So that is exactly sort of the story that we have in mind. But screen size, it turns out, is not going to matter. So we have like screen sizes of the devices. So I'll show you some results that screen size is not going to drive results. Yes, please.
Are you getting to explaining why you are able to avoid selection effect? Because so far it seems to me that you're doing the same thing that other studies do, that you look at, you don't really know who picks up a smartphone. Like, I'm imagining that is a very select group of people that differ from those who don't use their smartphone.
Yeah, exactly. So that is exactly the point, right? So we are looking at, suppose if you picked up the smartphone, we are just looking at your trade on the smartphone versus your trade on the desktop. That is the comparison. So we are not comparing people who picked up the smartphone versus those who did not pick it up, right? And then we can even do this within, like, let's say if you say, oh, well, maybe people who pick up the smartphones in the evening are somehow different from people who pick up the smartphones in the afternoon. So then we can look at, okay, let's look at within the same hour, the same person has picked up a smartphone and they have also made a trade on the desktop. So let's compare those. Please.
So do you have a sense of how much of the overall variation is due to this within? Because you're, getting very, very tight within
Yeah.
versus kind of just across, in the selection sense.
Right. So we do have those results in the paper.
Okay.
I don't remember, I'm not going to show them. So in the paper we have like without any fixed effects, and then we include different fixed effects. But I don't remember the exact magnitude.
When we get on to the results, I think these are all great questions.
Right. No, that's fair. Yeah. Okay. Another implication is going to be that even experienced investors, so those who have had experience of trading like more than 7 years, more than 10 years, even they are going to get affected, and elderly are more prone to these smartphone effects. Okay? all that these results are saying is essentially they are just questioning if we should rely on smartphones as a key technology to democratize finance. Okay, we are just pointing it out. All right. So before I go into the results, let me talk about the data a little bit. Where is the data coming from? And then who trades using the smartphones? Because you're absolutely right. Those who pick up the smartphone are going to be very different from those who do not. Right? So as I said, the data comes from 2 large German retail banks. We essentially observe all transactions that these investors are making. And then we have about 14 million transactions done by over 100,000 customers. So Adam, to your question, when we include within investor time fixed or within investor month fixed effect, the variation is coming from about 11,000 customers. But again, I don't remember the exact magnitudes. And then this is the primary bank for most customers in our sample.
A lot of trades.
Sorry?
It's a lot of trades per person.
Yeah, but he's going to whittle it down to people who do both. So.
Right.
No, I just mean 14, like the average person's doing 140 trades.
This is over a span of 11 years or something. Yeah, this is the sample period. Yeah. Okay,
I buy.
so let's look at who uses the smartphone versus who does not use the smartphone, right? So here, phone users are those who, across our sample period is going to be from 2010 to 2016. If they ever used a smartphone versus they never used the smartphone, okay? You see means and medians here. For the phone users, I'm showing you the means ex ante, okay? What type of variables are we looking at? So essentially all outcomes that we are interested in, we are comparing them. We are comparing phone users before they start using the smartphone versus the non-users. Okay, and that's the p-value of the mean difference, and they are pretty much different on any dimension that we can look at. To summarize, the smartphone users, even ex ante, they had higher trading activity. They were relatively risk-loving, and they performed worse than non-users.
How
Please.
many users do you have in each? I don't see the number. You see the trades, but not the the individual.
Yes, 25% of, so I guess around 25,000 phone users and then 75,000 non-users.
But when the app has been introduced?
2010. Yeah.
Just a clarification on this, I mean, you said earlier you're going to look at the further subset of people that use both phone and app, phone and
Yes.
internet.
Yes.
That's not what we have here.
That is true. That is not what we have here. So we are using this to motivate that, right? So we are essentially saying, oh, if you compare trades made by phone users to
The
non-users.
people who flip between one and the other are different. That's the relevant question.
Yes.
Okay.
Yeah. Okay. Even in terms of, if you look at some of their demographics, smartphone users are relatively inexperienced, they are younger, and they are more likely to be males. All right, so this sort of motivates the fact that, look, if we just compare smartphone trades to non-smartphone trades, then this issue that smartphone traders are different is going to bias our results, right? And so how do we compare across the same investors the same month? We allow the fixed effects to do that for us, okay? So essentially, this is a very simple specification that we run. It's an outcome variable for individual I for a particular purchase made using a platform J in a month T, and then smartphone turns on whenever that purchase is made using the smartphone, okay? And then again, the key here is going to be this investor by month fixed effect, which is going to allow us to compare within the same investor within the same month. All right. So the first question, the baseline question, do smartphones change trading activity? As I said, we'll be looking at 3 different types of outcomes. So we're looking at risk-taking, gambling preference, and biases. Yes,
You need to tell us the sample size of people that use both at the same time.
10,000. Sorry.
Okay.
Okay, so let's look at volatility first, right? So here I'm essentially looking at volatility is calculated as on a 12-month rolling window basis. So essentially the idea is, okay, if the purchase is made in June of 2015, let's look at this asset's volatility beginning for the 12 months before this purchase was made. Okay? What we find essentially is that the same individual in the same month, when they are purchasing using the smartphone, the volatility is much higher. If you compare this to the unconditional mean, it's about 33.4% more volatile assets that they are purchasing.
So, sorry, just again, sir, on the number of observations. So how do you get from the from 10,000 to 8 million?
So 10,000 is the investors, the number of investors. This is at the trade level. So the analysis is done at the trade
These
level.
10,000 people do 8 million trades in this.
No. So the fixed effects are capturing that variation for us, right? We are not manually throwing out people who never, let's say, who never trade on smartphones. That's the fixed effect that is doing it for us.
So
We are essentially keeping all purchases between 2010 and 2016 made by anyone across platforms, by the entire 100,000 individuals. But then what this fixed effect is going to do is essentially if you never trade on the smartphone, or if you trade, let's say if you have a month where you are only trading using non-smartphones, then you are just going to be thrown out. So the variation is not going to come from those observations.
So identification comes from the 10,000
No,
individuals.
I'm thinking whether that's.
But he has many more.
No,
Huh?
I was just, I understand that, but I was thinking whether that's.
Yes, please.
Just in general, can you see if they log on the computer and they log on the smartphone? Because I could imagine myself logging on the computer doing stuff and then just finishing the trade on the smartphone. Can you rule out cases in which you see them log in on platforms before trading?
I would have loved to, but unfortunately I don't see the logins. I mean, I do see login, but it's like aggregated over the day. So it's like this person logged in 5 times over the day. Yeah, but it's not like the time. We can talk more. Yeah, please.
So just to follow up on that, so I use Vanguard, it's got an app, I've got to log in, it's the same setup.
Yeah.
My experience is if I want to do a trade, I try to do it on my phone, and with certain asset classes and certain taxable, non-taxable accounts, that's easy, and I implement, and then sometimes it's annoying because of the asset class cross type of account, and then I move to my computer. So I think I'm exactly your focal person, and then, but
did you know you also did more intuitive thinking when you were doing your smartphone reads?
No, I'm going to make a trade X, and I have to decide which platform. And I start with the easier platform, the nearer platform, and then if it doesn't work, I move to the harder platform. Then we're just saying, are more volatile assets easier to trade on the phone than not, right? So,
Absolutely, yeah.
So that would be consistent with...
That's going to explain about 60% of our findings, but the other 40% is not explained by that.
So I have
Please.
a related comment, and that is, can you see the news that people are responding to when they make this decision? Because that also may be driving which instrument they're using to trade.
Absolutely.
Yeah.
No,
Can you see that in the background?
That's a great point. So we cannot directly see it, but so the way we have done this is we hand collected, or we scraped all unscheduled announcements made on all German firms, right, within our sample period, and then we compare days where there was no unscheduled announcement to days where there were scheduled announcements. We can also do it within the same day, but across different times. And surprisingly, the results are actually stronger when there is no unscheduled announcement. So it doesn't look like they are essentially looking at the news. Okay. All right. So our next set of outcomes are looking at gambling preference. We are looking at skewness. There are a number of papers that talk about skewness preference and then lottery type assets. And it seems like individuals are 46% more likely to purchase lottery type assets on their smartphones.
No clue what a lottery type asset is, forgive me.
Excellent. Yes. So I wanted to speed up, but you're right. I should.
It's rather fundamental to your petition, so.
Fair enough. That's fair. Yeah. So lottery type assets, we are essentially just following Kumar's 2009 paper, where essentially it's defined as it's a dummy variable, which turns on when the price of the asset is below median, but the skewness is above median, right? So it's sort of like...
It makes no sense to me why we call that something different. As a lottery, they're all lotteries.
Yes.
Full stop. I mean, that seems completely arbitrary. Does anyone know? I mean,
So The skewness measure, if you like it better.
Well, I know what skewness is, and I assume volatility is variance.
Yeah.
Okay, I know what skewness is. So EUT says you have an aversion to variability, not variance. Only a quadratic utility function says that, and no one uses that. So that's all. That could all be fitted in the EUT, it seems, or REU, or whatever. To me, they're all lotteries, is what I'm saying. I don't know why there's a petition.
Like all three are lotteries, is what you're saying.
Full stop.
Okay. Okay.
Is there a literature doing that? That's
Yeah, there's actually a large literature that is, so we are essentially just following exactly what.
I don't care about you following, but it's the fact that there's a large literature explaining.
All right, so if you think about biases, we look at under diversification, past winners and past losers. I'll just define past winners and past losers because they are more important for our setting. So essentially this is, this turns on when the particular asset is in the top decile based on returns over the past 6 months. Okay, again on a rolling window basis. All right, so what is driving these results? Okay, is it the case that investors are simply substituting some of their trades from desktop onto their smartphones? As I said earlier, if that is the case, then we would find that essentially their non-smartphone trades are becoming less risky, right? Because if I move my risky trades from one platform to the other, then the other platform's riskiness should decline. So now what we do, and this is going to be a different setting, so this is the only table where the regressions are going to be different and they are not within investor time. So essentially now we are looking at non-smartphone trades of smartphone users, right? Because we want to see what is the spillover on these other devices. How do we do this? We use a different if, where essentially for one bank, there was staggered introduction of the app. So iOS was introduced first in 2010, Android was introduced in 2012. Again, this is only for one of the two banks. And then we'll run a traditional different if, and then look at the same outcomes, but on the non-smartphone platforms. So across our 6 outcomes, if it's substitution, we would expect a negative strong result, but we are not finding that. If anything, there is slight positive effect. If we use just the technology adoption, then we actually find pretty strong positive effects. But because this is more, or this is better identified, I'm just sticking with this. And so taking the stance that this evidence contradicts substitution effects, right? So we are not pushing the learning angle. Please.
So what is the cross-sectional difference here? So the time series difference is before and after the introduction, right?
Yes.
The cross-sectional difference
is iOS users versus Android users. Because iOS was introduced first, Android was introduced later.
I'm sorry, can I ask, why aren't you doing this for all trades as an instrument for technology adoption? I mean, a reduced form version of this gets you the number of trades induced by the app, and then you can divide that by what share of people they added in, and you can get a treat and a latte and all that stuff. So why, by limiting this to non-smartphone trades, it seems like you rule out the ability to treat this as a clean instrument?
So we prefer the other instrument because someone can argue that iOS users are somehow different from Android users, and if those differences, are time
but you said you have staggered rollout, so you can compare iOS users the month before the rollout and the month after the rollout.
Yes. Yeah, I'm with you.
That's within user or within group.
That's true, but so if those differences are time varying, then that's the problem. But so I'm with you. If you prefer that specification, I'm happy to.
Well, it's just that what you did last time had no identifying variation because it allowed people to move across from one platform to another based on their preferences. Here we have an exogenous shock. Right? We don't think that iOS users systematically changed their preferences in the month before the technology was adopted, that it was introduced versus the month after introduction. Because you're not talking about downloading the app, you're talking about the app existing.
Yes.
So that's the exogenous.
Right. So if you prefer this one, I don't have it included in the paper, but we have run this and we find very similar results across both specifications.
So if you launch the app, it increases the amount of use on smartphone trades?
Yes.
And no effect on not smartphone trades except for skewness?
Yes.
Yeah, I think that's your...
This could be just because it's a weak instrument, no?
Say that again?
This could just be because it's a weak instrument.
That is true. It's only for 2 years because it's like 2010 to 2012. The previous one allows us to use the entire 6 years of data.
So, I mean, we can discuss this more, but
pros and cons.
It's a bit to me confusing to first show a result on the overall population and say there is an effect, and then you show a result on a very small subset of the population and see, look, there is no effect.
No. So what I'm trying to rule out here is our investors, the effect that we are finding, is it just coming, like now I've moved on to the mechanism, right? So
No,
is it just coming from substitution? Right.
Okay, we'll discuss this later.
Okay.
You are changing a bit
the sample. I'm changing the sample. Yes. So in the paper, in the appendix, we have with keeping the sample constant, the exact same sample, and looking at the previous specification, we find the same results. Yes, that's a good point. Yeah. Okay. So if it's not substitution, is it something about the features of the app, right? So let's think. Let me give you a little bit of a background about the app. So here it's not just a trading app, right? It's essentially like a banking app. Customers can use the app to check balances. Think of it like a Bank of America or like I'm hoping Bank of Canada has a similar app. And among other things, you can also trade using the app. There are no nudges or push notifications, right? There's no features of gamification that you might have seen, like Robinhood had those confettis flying around when you made a trade before, right? Did you have a question? Oh, you had, yeah, sorry.
Just a more basic question. Do people trade more once they adopt smartphones? Just the number of trades?
In total?
Yes.
I don't know the question.
Of assets, but is there more trading?
I don't know the answer to that question. So in total, I don't know. I know that they trade more on the smartphones, and nothing changes. I guess if you combine the two results, they are trading more. Yeah. But I have not run it like at the individual level.
They pay commissions when they trade. For each trade, there is like commission to the bank.
That's a good question. My guess would be yes, but I don't know. Okay. So, is it about the salience of the information? Maybe the app features the winners and losers more saliently, and maybe essentially when I'm doing a trade on the app, these assets look very salient, so I just purchase these assets, right? But when we exclude assets with extreme performance on either side, who are more likely to be focused or who are more likely to be displayed on the app in a more salient manner, we find very similar results. Very similar results for active mutual funds, which we know are never displayed on the bank's app. That's what the bank told us. Is it the screen size? Does the screen size matter? This question came up earlier, but we find similar results for iPads and iPhones. So assuming that they have different screen sizes, it looks like it's not about the screen size. Okay, is there a learning curve to the technology? Maybe, like some investors, especially if they are elderly, it takes some time for them to just get used to the app. But what we find essentially is that our results are essentially pretty much flat, right? So what I'm showing here is my main specification. I've simply split it into months from where they first made the smartphone trade. The identification is still coming from within the same investor, within the same month, okay? And then essentially what we find is that the coefficients are essentially flat during the quarters following when they started using the smartphone. Okay, so is it about the selection of assets and times, which was a question again earlier, and the answer is going to be yes. So now if we look at within the same asset class, right? So assuming that, if I look at only those purchases where I'm purchasing stocks in the desktop, also stock on the phone, still looking at within the same investor within the same month, the coefficients are much smaller, right? If you look at the timing of trade, which is in the same day, what time of the day am I trading? Again, we find that the coefficients are much smaller. You can also throw both in together. so trade hour by year fixed effect and asset class by year fixed effect. And essentially, the new estimates are going to range between 27% and 44% of the baseline estimates, right? And here is where I was coming from, that look, it seems like even if you control for the asset class and the time of the fixed time of the day effects, we are still about 30% of the results remain unexplained. Okay? So where is this variation coming from? Like, what is driving these results?
Can I just get a clarification? Sorry,
Please.
Pages, not a criticism, just a previous picture.
Yeah.
When you've got volatility and you've got 4.3 million observations,
Yeah.
Is that just volatility? And then you go to skewness. Are we doing volatility? Because they're two different assets that people are trading.
It's for the same trade, we are just calculating volatility and then calculating skewness.
Oh, sorry, and the lottery type assets then was okay. Let me focus on that one because they're different assets, right? So all these been done together. I'm not understanding if there's just looking at lottery type assets. Why isn't the N smaller?
No. So we are looking at the exact same sample, and we are just calculating volatility for that asset for the 12 months before the asset was purchased, skewness for the 12 months before, and then this lottery type asset is based on the price in the previous month and the skewness in the.
I'm sort of seeing regression coefficients here. Maybe I'm just misunderstanding this. They sort of look like regressions because you've got these R squared and stuff. So
yes, it is a regression. This is the Y variable, right?
Oh.
So volatility is just the Y variable of that regression.
Okay. You're certainly not running OLS on these, are you?
We are, yes.
Variance goes to minus infinity? I'll shut up. This is finance. You're allowed to do that.
I'm happy to chat more, but Lou, go ahead.
Yeah, before we move on, what happens if you do month times asset class fixed effects? So you have like asset times zero fixed?
Yeah, we just don't have any variation there.
Yeah, that's what I was curious about, because then the kind of previous comment kind of applies, right? Like looking at, and it would be interesting to maybe show some, like the trading across asset classes, because then that's still consistent with an idea of like, I just use my phone for different types of trades.
Yeah, which is one of the mechanisms, right? So we are saying
different types of like asset classes rather than
Or maybe another way to phrase it, and this is meant constructively, to think of those things that this Kumar guy calls different types of attributes of the lottery, which is a correct way to be done, and it's not being critical. Then you can have one bloody big OLS regression and just put different attributes in there. That would be far more interesting, it seems to me.
Gotcha.
But that's.
Gotcha.
So like it's not like you're trading the same stock, right? Like you're trading stocks and you're trading different types of stocks on both things simultaneously. I think that would be right?
Yeah.
So you're saying there's not enough variation across trading platforms within one,
for the same asset.
Exactly.
Yes.
Exactly.
Yes. Yeah.
But you do asset by year.
Yes.
No, that's what I mean. Like.
So she's saying that even within the same year, there might be differences on when somebody trades stock, like in January.
You cannot do month by month. You don't have a lot of trades.
Exactly. Yeah. Okay. So the remainder of the results, are they driven by more intuitive versus deliberative thinking? And so we are going to rely on this forthcoming paper in TJE, which essentially models this type of thinking. And the idea is that the deliberative thinking is costly, and so it is only triggered if the intuitive thinking faces sufficient amount of uncertainty, or maybe there's some sort of conflict, right? So one thing that I want to point out is like it's a little bit different from. So whenever someone thinks of Kahneman's system 1 versus system 2, it's like they think like it's either or, but it's sort of like a continuum, right? And we are relying on this model to essentially get our predictions from. Okay, so I'm going to show you a bunch of results which are going to be consistent with more intuitive thinking. So based on the model, individuals are less likely to engage system 2, which is again, system 2 is deliberative thinking, okay? When we have low glucose levels, such as before meals, and there are papers that show like just before lunch, judges are more strict, for example, right? We find stronger smartphone effects during pre-lunch hours. It's also stronger when the ego is depleted or when you're tired later in the day. We do find stronger smartphone effects during after hours. Stronger effects during the days where moods might be elevated, and then stronger results when we observe usual states. Okay, and this is what comes to Suzanne's question. Essentially, we look at two different outcomes, two different levels of heterogeneity. Excuse me. So stronger smartphone effects with days with lower market-wide implied volatility. Okay, so when there is not a lot going on in the market, based on implied market volatility, and for days with no unscheduled announcements. Okay. All right. So I'm out of time, I'm guessing, based on what I see there. Just really quick, the Sharpe ratio for trades made on smartphones is much lower. I'm going to just run through this. Even for experienced investors, which is this bottom panel, these are investors with more than 7 years of trading experience. Even for them, even though the results are a bit smaller, but we find strong effects. Okay? So let me conclude. Essentially, we are comparing trades within the same investor and month, and we find that using smartphones, the same investor is likely to purchase riskier trades, more likely to exhibit biases. They don't seem to be offsetting this, so it's not about substitution across platforms. Selection of what and when to trade matters, which also came up during the questions. And then it seems like the results are consistent, that the remainder of the results may be driven by more intuitive thinking. Okay? Overall, our results just caution against the indiscriminate use of smartphones as the technology to democratize finance. Thanks a lot, and I really look forward to Derek's comments.
Okay, so first and foremost, thank you very much for the opportunity to discuss this paper today. Just very quickly, what does this paper do? How does smartphone use affect investor efficiency? Transaction level data from 2 German banks to address this question. Not surprisingly, finds that cell phone use reduces efficiency. And I mean, I think this is a fairly well polished paper. I think we saw that this is a fairly well polished paper today. And just looking at the acknowledgments in this paper, we can see it's obviously very well polished. It's had the opportunity to be shopped around. So I'm not sure that I'm going to be able to offer too much more in terms of novel comments from what you've already received, but certainly I'll try my best to do so just briefly. So first and foremost, what do we like about this paper? What I really like about this paper is the richness of the data. So it's proprietary transaction level data from 2 large German retail banks, 10 million transactions on 150,000 investors. Not only do you have information on the types of investments, but you have technology used, time of day, sunlight, demographics, all kinds of information that makes this data set very powerful and very attractive from a research perspective. And on top of that, the institutional environment is ideal. And in fact, you didn't spend enough time talking about just how ideal this environment is, I think, because you have staggered introduction of smartphone use across apps, staggered availability of smartphone by operating system, and then variation in the take-up of smartphone use as well as intensity of use to study the impacts that these staggered introductions have on actual consumer use. So very interesting, ideal environment to study this as well. And so when you take these 2 things together, really all you need is one good regression equation and one nice clean event study, and you've got a really, really nice paper. I think everything beyond that would just be bells and whistles to make the paper longer to get it submitted. But one good regression and one good event study and you're done. So, and on top of that, I mean, the results are intuitive, right? I don't think it's that hard to convince a referee that the way that we use our computers, in our offices at home or in the workplace is very different than how we use our cell phones, or how we use our cell phones, or how we use our cell phones. And I'm sorry, Glenn, I didn't have one of urinals. As much as I tried, it just wasn't there. So, it's intuitive in an ex post sense as well. And I think we can really kind of just understand that the way that we use these things is different. If you'll permit me to digress for a second, it reminds me of another type of game that I like to play, where the way that we use our cell phones and our computers might potentially be different. And so what I've done is I've actually taken my own chess performance over the last 90 days and plotted this just to give you a sense of what's been going on with my own personal life outside of academia. And you can see when September hits, my performance falls, because of course it's a busy teaching semester and I start using my cell phones to a greater extent, I get into a period of lots of papers to grade and my performance really falls. And then lo and behold, I come across this paper and I say, maybe I should put away my cell phone for a little while and my performance bounces back. So definitely an externality of being a conference discussant, I would say as well. So the quasi-experiment here, in my opinion, is the model is, within person, within year by month, how does cell phone use impact investor performance? And it's very, very powerful that you have the ability to do that in data. It's rare that you can do that with such granularity to study within month what is going on. But at the end of the day, I think we've seen from some of the comments, your beta coefficient is not causal. Okay, it's not randomly assigned, and I think the real way of interpreting this is just by looking at my chess performance. There's two things that's happening. One is my cell phone use is impacting my performance. That much is clear. We can see when I put away the cell phone, my performance gets better, but I also stop grading too. And the busy semester means that there's a couple things happening here. One is the cell phone is affecting my performance, but on top of that, my own personal life is impacting both my cell phone use and my performance. And you have, fortunately, an environment that allows you to control for that. You've got a triple difference estimator. You're only doing double difference, and you're only varying it at the bottom of the paper. You've got pre versus post-reform, Bank A versus Bank B, Apple versus Android, and you can do all of this in a triple difference setting. So that's remarkable, and it should be the main specification and the only specification, and the event study is all you need to sell this paper, okay? Why does this matter? Well, because your findings are starkly different across these two specifications. You have non-random effects are large. Random effects are not large. And Glenn flagged the publication bias at the start of this presentation. This is the one you should be emphasizing, even though it's not a sexy result. Okay, so you talked a little bit about underlying mechanisms as well. You talked a little bit about system 1 versus system 2. System 1 is typically, I'm not a psychologist, so I had to Google this, but when you Google it, system 1 is detect objects that are farther away, sadness in a voice, yada yada, monitor your behavior in public, park in aerospace, that's system 2. Invest in smartphone, invest in a laptop, I'm not convinced. So as much as I like the idea of a conceptual framework to help guide your analysis, because so often you'll get a good quasi-experiment with no underlying foundation. I like the foundation in this case, but you need to be much more broad in your discussion, and the pictures that I showed are a good way of motivating this. People just use their cell phone differently. You don't need system 1 and system 2 to convolute it, because without a credible identification of system 1, system 2, you're distracting. So just talk about the different potential mechanisms and be more upfront about that. So lastly, you talk about policy recommendations. You say your findings are caution against relying on smartphones as leading technology to facilitate retail and investors, access to financial markets. That's fine. Your results are definitely consistent with that. But having said that, you need to know more about what's going on at the extensive margin. Are you attracting new people to participate that weren't doing that before? If you're only looking at within, then you're not really able to say something about the broader general equilibrium effects of the introduction of these programs, or the introduction of this software, so it's not clear what the broader policy implications are. A couple of other comments, there's a graph like that where you talk about kind of delayed effects. It's hard in an event study to think about that as a delayed effect. I would put more emphasis on the fixed effect estimation in the paper. And then you also find stronger effects for younger and less experienced investors. That's consistent with a learning by doing story, so I'm not sure that the story that you're telling of system 1, system 2 is even consistent with some of your other findings in the paper. So just to conclude, a very, very nice project, very excellent data, definitely a recommended read, but I would be emphasizing different findings in the paper.
Thanks a lot, Derek. It's really great when the discussion starts the discussion with having the paper has been presented at blah blah blah. Anyways, a couple of points that I would like to push back on. So the smaller effects that you're talking about, it's not apples to apples, because the smaller effects are on the non-smartphone trades, right? So it's looking at the spillover.
That's a specification error.
So I'm coming to the specification. Well, no. Even with the same specification as an answer to Mika's question, in the appendix we have a table where we find the exact same results. So even if we look at just the same sample, we still find very similar.
Then move the appendix to the front.
Fair enough. The other thing I'm glad that you brought up. Let me stop the usage of smartphones, because this is a new analysis that we have done. So essentially, there were outages that happened on like cell towers. We don't have that in the paper. I also did not include it in the presentation. So there were outages in the cell tower where essentially the smartphone trading went down, stopped, but you could still trade on the non-smartphone devices. And even there we find very consistent results, just like how your productivity is going up. So the only other issue, I guess, I'll just stop there because I think the main point was identification, and again, I don't think the smaller effects are for those, and then the outages will help with the other concern. Yes, please.
So we actually did a paper 10 years ago, and we were kind of very surprised. It was just almost by chance that we were looking at the people. In this case, they used a smartphone just for method of payments. And so we actually look at them, and like in your paper, they have all the worst outcome. So again, kind of technology seems to not help necessarily, and we think there is a bigger factor actually of selection. And then even when we look at the people that use the app, for example, they overdraw their checking account, and then we use the app, for doing finance, they actually also add the worst outcome. We think it's all selection. But one of the things we thought about is the idea that people use the smartphone because they think they make them smart, right? Or that technology somehow will help that. And actually, if you look at the selection of the people who use it, interestingly, there might be kind of that idea because they are disproportionate in our sample, lower income, some minorities and things like that. And not to brag about financial literacy, but the people who actually have higher financial literacy have less of these bad outcomes. So, a little bit of that effect, doesn't kind of solve the selection or anything like this, but just to, perhaps another channel that, this technology might be a substitute for people thinking, somehow if I use my phone, it's going to be right.
Yeah, no, I'm glad you brought it up because even in our setting, these people who use smartphones are very different from those who do not. Like, they are more likely to be males, they are more likely to be younger, they are more likely to be taking riskier trades even ex ante, so it seems to be aligning pretty well. In terms of financial literacy, we do not have like a proxy to measure it, but one thing that might help with that on the margin is like even when we look at people who have long years of experience doing retail trading, even there we find results, but they are smaller results. So it's sort of consistent, but again, that's a caveat that to the extent that is measuring literacy. Yes, Stefan, please.
So you only look at purchases because there you have the full menu, I guess. But what about sales? Are people more likely to use their desktop for sales? Or are there certain assets that are both bought and sold only via smartphone? So there's some kind of smartphone mental account for certain assets? Or do you look at sales at all?
That's a great question. Now, we have abstracted away from sales because at one point we were having this discussion of maybe looking at disposition effect, but then we would have to make some sort of assumption on like LIFO or FIFO in terms of when the stock is purchased, right? And so we wanted to abstract away from that assumption. But I guess what you are asking does not require us to use that assumption, so I'm happy to look at it for sure.
So you do have data on sales, but you just don't use it?
That's right.
Okay.
Clarification. You mentioned at some point in the presentation that you have similar results for smartphone and iPad.
Yes.
But then it's a little bit of a puzzle to me because it seems from a lot of things that have been said, including what the discussants, that one explanation to be we use like smartphone in a very different way, more compulsive. The iPad seems to be like somewhat closer to the desktop than the iPhone, so we don't use the iPad with humans, I guess. But then I don't know. I really don't understand. So it's more like, it seems to me in this case more like a feature of the app versus. So I don't know. Again, the mechanism, the fact that the iPad and the iPhone are similar, seems to me very very difficult to rationalize.
No, excellent question. Yeah. So one way, like the way we are thinking about this is okay. So when you're working on your smartphone, it's a touch screen. our minds are trained to do everything quickly, right? I'm texting someone, I'm purchasing something on Amazon, so I'm doing everything very quickly. So even when I trade, it's like it's a high stakes environment, but I still carry over the same behavior, right? So it seems like a similar thing might be going on with iPads, where I'm trained to like just do everything very quickly, and I'm just like.
But is there evidence, for instance, that you mentioned, like that people have seen like Amazon purchases, if they differ between like desktop and
there is a paper in marketing that shows that Amazon purchases are more impulsive when it's done on the smartphone. Yeah. Yes, please.
So yeah, I wanted to come back to and kind of clarify why I think the within asset and like month variation really matters, and I think it kind of supports the point that the discussant makes, because it seems important that you want to use the quasi-experimental angle rather than like. I think your findings right now, they could be perfectly consistent with like a segmentation story where you just use your smartphones to trade stocks. And if the counterfactual, you care about the counterfactual where people don't use smartphones, right? And it's not clear that it will trade stocks more. But I think what you may be also finding, but right now with the headline results, it's very difficult to differentiate, is that they trade stocks more because they use stocks. So it's a treatment, that kind of treatment effect. You only get that with some kind of quasi-experimental interaction.
But even there, so we are looking at like stocks, like we have asset class by year fixed effects, right? So we are comparing stocks purchased.
That people don't seem to trade stocks, just the pure asset class, not even like the same stock.
If it was the same stock, then the outcomes would not vary at all, right? So there's going to be
exactly. But like the point is that they don't seem to trade stocks within the same month across, like either on their computer or on their smartphone. That seems to be more evidence of segmentation rather than like the variation that you find is perfectly consistent with people just using their smartphone to trade stocks, to trade different assets.
Let's talk more. But yeah, so I think so one other reason which also came up during the talk, which so there are two reasons why we have our preference is within investor month. One reason is iOS versus Android. So I'm glad that anyone in this audience does not think that that's an issue. The other issue is that the staggered launch happens in 2010 and 2012. So essentially then we'll be identifying our variation from just these 2 years, right? But if we use investor month, then we use essentially data for like 7 years. So for example, things like, is there a learning curve? Like how long lasting are the effects? These are things that we won't be able to look at with that specification.
You were talking about the power outages or something like that.
Yes, so the power outages are spread out across the sample period. So that we definitely plan to include in the paper.
Sorry, why could you not do the longer term effects? I mean, the whole point of an event study is to use the quasi-experimental to analyze the short term and the longer term. You can see all that in the graph.
Right,
the identification comes from what occurs with the introduction, but then you study the short term and the longer term effects just by looking at how the dots change over time.
Right, but think about where the dots are being verified from, right? So I understand you were touting triple difference.
Source of variation that you care about.
Well, it was coming from iOS versus Android, right? So if I just look at iOS versus Android, in 2010, iOS app was launched. In 2012, Android app was launched. After 2012, everybody's treated, right? So there's no control after 2012. So we can only look at for 2 years, right? So that's the reason why we cannot look at long plots. Yes.
So I was wondering if you observe to try to provide direct evidence of what you said before on the way we use the smartphone, whether you observe the time that people spend on the device that sometimes is available, or if not, the number, let's say the number of trades per hour that they do, something like that. I mean, so I guess having a little bit more outcomes which are directly, a behavioral outcome as opposed to a volatility or something that is not necessarily what the investor observe.
Right.
That in this interpretation.
Right. So we don't see the exact time that was referred to the earlier question, but we do see like the number of trades by hour or whatever across platforms. So we can try to look at that. Yeah.
Awesome. That was a good chat. So I think we're going to move on.